Wait for another 5 minutes for other people to join in, and then we can start. Hi, everyone. Thank you for joining us over on the weekend. My name is Raghav, and I look after the investments at SBNRI. So we are a platform for NRIs and OCIs, started back in January 2020. We offer services across banking, investments, and taxation. In terms of banking, we have partnered with a partner bank such as DBS, Axis, and DBS, Axis, and Yes Bank. In terms of investment options, we have all sort of products. So we have mutual funds, we have PMSs, we have startup equity, we have commercial real estate. Uh, we also do fixed deposits. Also, in terms of services, we offer taxation services. So when you invest and bank in India, you would want these services particularly. So we can help you with your income tax filing in India. In terms of repatriation documents, in case you need 15 CA, 15 CB certificates, we can help you with it. In case you have PAN related queries like correction or PAN Aadhaar linking, all of that can be taken care of in-house, right? So as an NRI, particularly when we interact with you, we got a lot of questions as to how equity markets are performing, and how do we navigate out of this entire scenario during elections. And hence, we decided that we do a complete webinar on how we can navigate equity markets during elections, right? So we will cover the following points in the webinar. Number one, why India, right? Essentially, why you should want to invest in India. And in case you want to do that, how can you essentially do that, right? So what are different products, what are different asset classes, wherein essentially you can invest in India correctly. So that is what we'll cover in the points. So let's begin. So why India? Particularly, I'm sure all of you staying out are listening as to India is growing, but we'd have to really understand the broader sentiments as to why it is happening, right? So you would know that we are the world fastest growing economy, right? So we have been growing at about 6-7% each year for the last 20 years, which essentially is greater than much developed economies, and also within the increasing also in the emerging economies, right? And why that is happening is primarily because we have been seeing a very increase in the domestic consumption. When I say domestic consumption, people are really getting rich, our per capita income is going up, and essentially, once that happens, there's a lot of spending which happens within the economy, right? Particularly, you all staying out, NRIs, you are sending money to your family and friends in India. They are spending this money within India, and hence that is increasing the growth rate. Second, we are the world's largest workforce, right? So wherein we are seeing a trend, all the entire world, they are facing crunch in terms of workforce, right? So they don't have people to work for the economy. Vis-a-vis in India, it is just the opposite. In the last decade, we added about 103 million new people who are well-read, well-educated, well-skilled, and are ready to work. And when that happens, you would essentially see most of these economies going up. And such is the case with India as well. Third, very important point is revitalizing the manufacturing capacity. So you would have seen government for the last 10 years have been focusing majorly transforming agri-based economy to a manufacturing-based economy. Particularly what essentially China did during the 90s, right? That is what we are seeing in Indian economy as well. And Make in India is doing such thing, right? So you would see Apple moving its manufacturing to India. You would see a lot of automobile companies essentially manufacturing in India and then exporting out of India to the world. So that itself gives a lot of boost to the economy, right? We are seeing the fourth important point, which we are seeing is the participation of domestic investors and foreign investors in the equity market in India, right? So we have seen 977 billion worth of inflows during the last 4-5 years. And this makes our stock exchange particularly very mature, liquid, deep, and we are well versed and well diversified stock exchange across sectors and companies, right? And this makes NSE, which is our one of the largest exchanges, the world's biggest in terms of derivatives, right? And then you have global competitiveness. So when I say global competitiveness, India moved up 6 places from 44 to place number 38 in terms of logistics, logistics production index, right? That is a huge number to see when you see that. We added roughly 1.32 billion were added into digital stack, which is the India stack in India, particularly to encourage the digital economy, right? We added close to 2 lakh crores worth of savings account, 2 lakh crore worth of savings through 500 million savings account via the Jan Dhan Yojana. And all of this essentially gives a lot of confidence to FIs and DIS to essentially participate in the growth of Indian economy, right? Now, essentially, we come back to the next very important point. If India, then how can you participate, right? Where can NRIs invest in? So any economy generally gives you three places or three asset classes to invest in. That is real estate, you have public markets, and then you have private markets. So real estate particularly has been a very favorable investment, particularly for NRIs. But there are a lot of challenges to do that, particularly if you were to buy a real estate. So you have to come down to India, do the registry and all of that. But SEBI particularly recently came out with a regulation called as Small Medium Real Estate Investment Trust, which allows NRIs to digitally invest into commercial real estate market in India. We have covered that in one of the other webinars which we conducted. But then, yes, real estate participation for NRIs is essentially growing. and going to be a really easy task going forward. Then you have public markets and private markets. In public markets, you have equity markets, particularly via stock exchange, and then you have debt, particularly government bonds, RBI bonds, and all sort of those products, right? In private markets, you obviously have equity, so you can take equity exposure into stocks which are not yet listed on stock exchange. And then you have obviously DIS participate a lot into putting the debt money in these companies, which happens via the FDI route, right? So this particular webinar is for public equity markets in India, right? So essentially, NRIs wanted us to create a cheat sheet wherein they can get all the information in one glimpse, and hence we created this one of the cheat sheets for you to take a closer look at. So when you want to invest into public markets in India, there are essentially four routes. Either you can uh, directly invest into the stock markets yourself via opening up a demat account, or you can essentially take help of the fund manager who would essentially manage your portfolio. For these, there are various products like mutual funds, portfolio management services, and alternate investment funds. Now, minimum investment typically varies in all of these products. So when you invest in mutual funds, the minimum investment typically is about 5,000 rupees. When you invest in stocks, generally people start with roughly about 1,000 bucks. For PMSs particularly, which is portfolio management services, the minimum ticket size prescribed by SEBI is 50 lakh rupees. And in alternate investment funds, which essentially are more sophisticated public market participation instrument, there the minimum ticket size ranges between 25 lakhs to 1 crore. Mostly it is 1 crore, but 25 lakhs under category 1 angel funds is allowed, right? Now, how are these different instruments practically aligned with your goals, right? So mutual fund, obviously, yes, you can always put it in your portfolio. One who wants to take equity exposure, definitely yes. Does stock align with your portfolios, with your goals? Yes. PMSs, typically for someone looking to generate wealth over long term, say 5-7 years, yes, it does. But generally, because of the higher ticket size, 50 lakh rupees, it might or might not suit between your goals. So you'd have to look at your portfolio allocations to that. AIF, same answer. Now, how easy is it to invest in various instruments, right? So for mutual funds, you do not need a demat account. The KYC process is fully digital. You can use SBNRI app to invest in mutual funds. It is relatively very, very easy, right? When it comes to stocks, portfolio management services, and alternative investment funds, the KYC process is slightly tedious, primarily because you have to go through the entire process of demat account opening. And essentially, uh, initial uh, uh, initial effort is what you would have to put in to complete your KYC, and then essentially you're good to go. Now, when I say time zone here on the sheet, by time zone, I mean how often do you need to review your portfolio, right? So for mutual funds, monitoring once or twice a year is fairly okay. Your stock investment, which you make particularly yourself, you would have to do daily monitoring. Obviously, you need to track entry prices, exit prices, valuations, and all stuff like that. So it could be fairly difficult, right? For PMSs and AIF, that is not the need, primarily because that is the job of a fund manager, and hence you don't have to actively track. How easy would your life be by investing in these? So mutual funds, your life is easy. You don't have to worry. Just monitor your portfolio once or twice a year, and you're good to go. For stocks, might not be for somebody who is in the financial markets, who regularly follows the market. For them, it might be easy. For particularly people in tech, product, consulting, who generally do not track, or people who are staying, say, in the US, who have a huge time gap with India, for them, it might not be as easy investing in India, particularly through stocks. For PMSs, yes, once done, you don't have to do anything. You can simply track your portfolio. For alternative funds, similar case, right? So one simple highlight, which I put in the end, which is the remark. So for mutual funds, yes, it is easy, simple, and rewarding. KYC process is fairly simple. Minimum investments is less. Your ease of life is good. So definitely a go-to instrument. For stocks, yes, only if you monitor very, very actively. If you're tracking markets, it is easy. And if you have that confidence that you can generate returns which beat the benchmark, definitely yes. For PMSs and alternate investments, if you're okay to take minimum effort in the beginning to open up your accounts and set up all of this, post that, obviously you're good to go, right? In today's presentation, we would essentially focus mostly on portfolio management services, right? So we'll just move forward. Public equity markets, portfolio management services. So PMS industry in the last 7 years has boomed from 1.69 lakh crore to 6.19 lakh crore, which itself is a 20.3% CAGR, right? So we have grown 3x in the last 7 years as an industry standpoint, right? So what is a PMS, right? So what a PMS typically, what happens, there is a fund manager who would essentially open up a demat account in your name, and he would invest into stock, debt, and structured products, right? So versus the mutual funds wherein you own the units of a mutual fund, in a PMS, you directly take exposure into a stock into your own demat account. Now, the minimum ticket size on a PMS is a 50 lakh rupees, which essentially is prescribed by SEBI, right? So it's a one-time investment. You'd have to put in 50 lakh rupees upfront, right? In India, there are roughly about 250 plus PMS houses who offer 855 active PMS schemes, right? Now, selecting between all of these could be a little difficult. That is where SBNRI comes in. So we have studied most of these schemes, and we have shortlisted a few of them. So we'll just take you to the modus operandi as to how did we do this research, how did we shortlist these PMSs. So essentially, you need to take a broader look on 3 parameters as to how would you want to select a PMS scheme. Number one, you should identify a good fund manager. Now, how would you identify a good fund manager is you have to understand how long of an experience is there with a fund manager. For how long has he been investing, whether it's large cap, mid cap, small caps, doesn't matter. But you should identify how long has a fund manager been in the industry. What sort of strategy does he run? How consistent has he generated returns which are outperformed? How often does he churn the portfolio? By churn, I mean how often does he sell companies out of a PMS stock portfolio, particularly? How does he construct a portfolio? When I say construct a portfolio, it means what various parameters does he look at when investing? So does he follow a bottom-up approach? Bottom-up approach typically means that you identify a company, you identify the market, you identify the industry it is in, and then you do a micro to macro, you go up the hierarchy, right? Similarly, there are bottom down approach as well, wherein you figure out the industry first, that okay, you see that this industry is going up. You would figure out what companies are there in that industry, how well are these companies placed, and then you do a fundamental analysis of that company. So what sort of strategy does a fund manager essentially applies while selecting a company, right? Does he speak to the management? How well does he define the entry points of a stock? Entry point as an entry prices, and exit strategy. What sort of exit strategy typically a fund manager use? So all of these parameters is what we used while shortlisting these PMS schemes, right? Today, I'm going to introduce you to one of the fund managers or one of the PMS fund managers, which is Green Portfolio. From Green Portfolio, we have Sriram with us. Sriram is a CFA charter holder and is a VP at Green Portfolio. Sriram essentially leads various business verticals along with the analyst team. He has been with the Green Portfolio for about 4 years, and he has had intensive experience in running PMS strategies and selecting stocks. So welcome to the webinar, Sriram. Appreciate your presence. And
thank you very much, Raghav. Thank you very much. Thanks. Yes. So, Raghav, thank you so much for the introduction. Look, 2 items you have mentioned, small cap, mid cap, large cap, which areas do these PMS managers go to is one of your criteria. Then is it a bottom up or a top down approach? So we are into small and mid caps. It's not, we don't invest in companies like ICICI, HDFC, Reliance, because we don't want 10%, 15% growth is not what we're looking for. Look, if you invest into any mutual fund, ideally you would have gotten in the last 5 years like 17%, 20% kind of returns. What we have achieved is 25% plus in the last 5 to 6 years, and we want to maintain that. And for that, if you invest in Reliance or all these big names that everyone is covering, everyone knows about, you cannot see that growth. So what we are investing in is, let's say, telecom product manufacturer, or very niche infrastructure companies, or companies that are into renewable energy, and that too at different stages of the value chain. And that's how we unlock value. And our categorization is that we invest in companies that with market capitalization of below 20,000 crores. Okay. So yes, Raghav, you can go to the next slide. Hi. So firstly, look, I want to take a top-down approach and tell you, like, first, why India, how India stands out compared to other countries. Even though it might sound very boring because everyone covers it. I will quickly run through it within 5 minutes. That's it. A lot of charts, but 5 minutes I'll run through it. Then I'll talk about, okay, if India is growing, you want to invest in India. Now there are concerns that market has a dream run in the last 3 years after COVID, and it has done better than US, all of the markets. So is it worth investing? Is election rally kind of factored in already? Or is there specific stocks? If you're not investing in the entire market, you can invest in specific stocks or specific sectors. So is that possible? Then I'll talk about how we screen stocks. Like everyone, even if they're investing individually, they'll have their own unique principles, unique style of investing. But I'll just tell how we find companies. And I will even speak about one of the companies we're investing in. Look, it's very easy to show, okay, in 10 companies, let's say one works out, for example, I can display the good and completely negate the negative. But I'm not going to talk about a company that has done really well. Neither am I going to talk about a company that has done poorly, but I'll talk about a company that we're currently investing. So you will see what a current thesis is, and then, see if that matches your philosophy or if your philosophy matches us. So, and we'll do it a question and answer session. Yeah. So firstly, emerging versus developed markets. Emerging is countries like Russia, China, India, Brazil, Mexico. These countries' equity market compared to the US, Europe, UK, which are developed economies. So emerging market has done much better in terms of returns when you compare it to the developed countries like the US. Even though the volatility, if you see the chart, there are a lot of ups and downs. Even though the risk is high, the returns have also been able to compensate for that increase in risk. So next slide, Raghav. And look, emerging market, all these countries combined contribute around 30% to global GDP. But in the entire world equity market, it's only 6%. So there's a huge scope for these emerging markets to grow. Now, if you see, before the premise was that, look, you're US, you're UK, so your balance sheet, your finances are much better, it's well in place. But then what's happening is quite the opposite. If you see, hello, yeah, can you hear me?
Please go ahead,
Yeah.
we can hear you.
Yeah. So I was saying that.
Can you hear me?
Yes, yes.
We can hear you.
Developed markets, they've in terms of debt to GDP, theirs is much higher. They do not have fiscal discipline despite growing, despite the previous growth. So the balance sheet of emerging markets, in fact, are better than the developed countries at the moment. Next slide. Yeah. And India, if you see, especially in the last 6 or 7 years, the focus on infrastructure to create, let's say, roads, railways, defense, this focus has increased. Before, this wasn't the case. And because you have a better infrastructure, more businesses are coming because it's easy to commute. With more businesses coming, more manufacturing units are being set up. More manufacturing units are set up, meaning there are more entrepreneurs, there are more workers, and their disposable income is increasing. Because people's disposable income is increasing, they're able to spend, and the economy is able to do well. And it's a big cycle, but that cycle has started. That is the point. Clearly, I can go through the numbers, but it would be a bit boring. But the focus has increased on infrastructure, railways, defense. If you see India's railway, despite the Vande Bharat or the new bullet trains that has come or in under development, India has not done anything in railways. In fact, the bullet train that we speak about today, as if something new, was first done in Japan in 1970s. And now we are doing something about it. So railway is a huge scope, infrastructure is a huge scope. And on the right-hand side, we can see India's manufacturing activity, despite all the ups and downs, has been consistently increasing since 2022. China's has reduced, US has come to contraction. UK has come to contraction. Basically, what this 55, 57, or 56 on the chart means is that anything above 50, meaning manufacturing activity, is done better. Below 50 means it has contracted, like contraction has been seen in other countries like UK, etc. Next slide, please.
So Shriram, like you mentioned, that Indian markets have had a dream run for the last 3 years, right? How do you see these Lok Sabha elections particularly impacting these returns or stock market performance?
Look, very candidly, a lot of euphoria, a lot of optimism that the incumbent government will come to power has been priced in. Uh, and even, let's say, even the government is getting involved in the market, surprisingly, like, by the statements. So that euphoria can be seen, to be very frank.
Sure.
And even if you see, look at the multiples. So the euphoria has been priced in. Now, what if that euphoria does not materialize? Meaning that result that the incumbent government winning by a high margin does not materialize, then we can see some disturbance in the market in the short term. But we think, look, if you are investing in companies that are highly reliant on making political allies and things like that, there are companies like that, then that companies might never recover if something, if what's expected does not happen. But if you are investing in companies that has good governance, their future is bright, even if the market corrects by, let's say, 10%, 15%, these companies will rise. It is not an issue. India as a whole is still growing. I don't think there is anything that can stop that growth for the next 10, 15 years. That is clearly visible now.
So essentially, short-term negative returns could be a possibility if they do not win by large margin. But if you have chosen companies, if you have selected stocks which are fundamentally strong, you would see these stocks essentially might give you some entry points. But overall, you will see markets going up, right?
Spot on, absolutely.
Absolutely. Should I move to the next slide?
Yes, please.
Sure.
This is FII. The foreign participation in Indian markets has increased. Even the last 3 months, we saw an outflow. Still, compared to other countries, we're doing much better. So foreigners are coming. In fact, when we speak to NRIs and foreign investors, there is more receptiveness from their side compared to locals. So next slide. So India, I think this is all things that has been covered by you, Raghav. But India is the fastest growing country in the world. There are companies like Mozambique and these sub-African countries that are growing faster. But these are not major economies. These are very small economies.
That are growing faster. These are not major economies. These are very small economies.
Next.
Sure. So Shriram, we have one of the questions in the chat bot, which says that, do you have any previous data to support what happened during elections?
Do not have that data because we do not have the data, no.
Okay.
But the volatility is seen. So essentially what happens is right before elections, the market sees a dip. That is clearly visible. Around 7%, 10% dip is seen before the results are announced. That is a constant.
That's a constant. So volatility during elections, particularly maybe a quarter before elections, that's constant. But there isn't any data which supports that the markets have given major negative returns for a long period of time post the elections, correct?
So what happens is, when you zoom out and look at it, you don't recognize that what has happened before elections. You don't go into the minute details. When you look at a 5-year data, that blip or hike might seem very minuscule. So I do not have the data, but data is there. But I do not have the data.
Sure. Okay. So we'll go forward.
Sure. This is the most interesting slide for NRIs. So Raghav, when I speak to someone and they want to invest in Indian market, they understand all this. The biggest concern is, let's say, boss, I make 20% returns. The 20%, 2% goes my tax. Let's say long-term capital gains, best case scenario I'm taking. Now I'm 18%. Now 18% is saying, boss, they'll take the tax, the INR depreciation. Because let's say I transferred dollars and invested in INR, or I converted dirhams or dinars or riyals or whatever it is.
Depreciation or dinars or riyals or whatever it is converted.
Since the year 2000, INR has been depreciating by 4% per year. If you see from 2010 to 2024, INR is depreciating by around 2%, 2.5% per year, which is not good for a foreigner to see. And the biggest stigma of investing in India is this, that INR is depreciating. So why will I, keep my funds in India? Why will I invest in India? But if you see, India has never been in a stronger position ever. The forex reserves that we have is like $650 billion. So even if INR was to depreciate because of some macroeconomic factors, the RBI has sufficient reserves to hold that depreciation. And it is RBI has come out and said again and again, look, INR might depreciate, but it will not depreciate at a very large scale, because even we will, come into the markets and do the sell the dollars. And they have done this also when US recently increased interest rates. I think it was around 6 months, 1 year ago. The dollars that they had forex reserve, they sold. So point is, if you see, INR USD volatility is the lowest since 2005. So that is showing how stable the INR is compared to all the previous years. So you cannot say that, boss, history, this has happened, so it will continue happening. Let's say 3%, 4% will fall. That we believe that is not the case going forward. That severe depreciation will not come. Next.
Got it.
And look, as an NRI, you might have invested in different markets. US markets, you might be having a broker. Europe markets, you might be there. But if you investing in India, the correlation with other markets are less. Like you can see the chart. It's a quick glance. So the India's correlation with the S&P 500 or the US market is only around 0.5. So like 50% correlation. But other countries, China and China, Japan, or Korea, etc., these are highly correlated to the US markets. Next. And see, last 1 year, India has done much better than the S&P 500. So you take the top 500 companies of India, compare that to the top 500 companies of the US. India has done better with lesser risk. Now you might say that INR depreciation is not factored in, but INR depreciation has been very meager in the last 1 year. Despite, you see, INR's done really well. You look at Japanese yen, you look at Chinese yuan. These currencies have not done well because US has strengthened, but India rupee has stayed stable. So all in all, what I meant to say is, even if you take a short-term view, forget the long-term that India has outperformed us 7%, 8% margin on a compounded basis. Short-term also, India has done much better. Next.
So Sri, in short term, dollar might not have appreciated as much, but when you invest in any equity structure, right? For example, be it mutual fund or be it a PMS, you generally invest it for a long term, right? Say 5 to 7 years, in order for you to see substantial gains. Now, how do you see dollar appreciation versus INR in the long term? So that you see, most of these NRIs are essentially vary about INR dollar appreciation, right? Or depreciation. So essentially, how do you see that in long term?
Long term, as long as India is a growing country, it is growing at 7.5%, 8%, they'll have to borrow. And because they'll have to borrow, the INR should essentially reduce in value compared to the US. Like 82, we might see it at 85, 86 eventually, but it will be in a gradual basis. Because when I was speaking to NRIs in 2022, let's say, they expected INR to be at 90 per dollar by the end of 2023. That has not materialized. So my point is, INR might depreciate in the long run because India is growing at a fast rate, but it won't be at that pace that NRIs has to be concerned, boss. I'd rather invest in UAE or I'd rather invest in the US compared to India.
Sure. And how do you see Indian markets performing against the US market in the long term? Do you see we can essentially set off this INR dollar depreciation, particularly against the excessive returns which we make in the Indian markets compared to that of the US markets? Can we say that? Or would you have
Definitely. No,
data?
definitely, because it's simple math, right? In US economy is growing at like 2.5%. Of course, there are AI companies. Nvidia posted 253%. Like Nvidia is seeing super nominal growth, but not every company in the US is AI company or a chip company. And in India, if you see, the economy is growing at 7.5%. And in the entire Nifty 50, or if you take a broader market, Nifty 500, all these companies are going to benefit when India grows.
Sure.
So stock market is, in the end, is just a reflection of the GDP growth of a country. So if
Correct.
India's GDP is growing faster by, let's say, 2 times or 3 times faster than the US, then markets should also do well, better than US.
Would you have any 5-year data to support that?
5-year data, not at the moment, but even after adjusting for the dollar, let's say INR depreciation, Indian market has done well. You compare Nifty 50 to the S&P 500.
Got it.
So we talked about the macro picture, but then not every sector you can invest into every sector, because let's confront the fact that markets are at an all-time high. We sometimes see a dip of 5%, but then a rally of 7%, 10% right after that.
Sure.
So if you look at the multiples also, price to earning multiples, which is a valuation metric, the overall market is trading at around 30 times, which is far more than the average of 25, 24. And if you go sector wise,
Far more than
if you go sector wise,
if you go
there is
sector wise,
banks, there are IT companies, there are cements, so automobiles. These are the major sectors in India in terms of equity markets. Now, let's say you take, let's say automobiles. Automobiles, four-wheeler vehicle sales has not done that well. Two-wheeler has done really well. Tractor has not done well. But the multiples are like 30 times of earnings currently trading at. Then if you look at cement companies all about infra and rural housing, etc. But they're again trading at 32, 33 times earnings. Then you look at IT companies. IT companies are going to grow maximum 1%, 2% year on year. Infosys, TCS, and all these companies, they're coming out and saying that, boss, we won't see that previous growth that we've seen going forward for at least next 2 years. But they're trading at 32 times earnings. So there are pockets of market. I'm not saying entire IT, every company in IT is overvalued or same for cements, but I'm saying that there are sectors that are overvalued. And as an investor, or let's say as a fund manager, if you're delegating the task, it is our responsibility to find that sectors, and in that sectors, which companies, and then invest. So the sectors that we are interested in, like a bit out of the box, is 5G telecom equipment manufacturers. For example, 5G, when people say, it's usually Airtel or Jio or Vodafone Idea that comes to mind. But there are companies that manufactures equipment that goes into the towers. So there is, I'll discuss about a company later. But so 5G is a huge opportunity for India, because most of the products that you see, like for example, we're speaking today, it might be broadband connection or Wi-Fi, but it is supported by a Huawei equipment, meaning in the network, it's mostly Huawei, Ericsson, Nokia, all foreign and Taiwan and international players. For example, Huawei is China. But now government is saying that we want to indigenize it, that we don't want Chinese players, that eventually we want to have complete indigenization in the network. So there are companies that are doing this or about to do this, and that's where we want to be. Infrastructure is one. Infrastructure, of course, companies that are into roads, buildings, developers, these are done well. But even in infrastructure, there are niche companies. For example, we are invested in a company that is into laying of oil and gas pipelines, only pipelines. And this company will see a good growth because it's very untapped industry. There is no like 100% direct competitor that they have. Then chemicals. Chemicals is, in fact, we spoke to a promoter and they said they're coming from a 15-year low. The chemical industry has not seen these times, these depressed times, since the last 15 years. And green shoots are showing up. The export is increasing. The demand from the US is increasing. Pigment sales is increasing. So these are the sectors that we are looking into. Look, we might be wrong, we might be right, but it is important to see, where we're investing in, how we perceive the markets, and make sure that we have a thesis that why we do or why we invest where we invest. Next slide, please. And look, while investing, these are the bare minimum parameters that we look at. For different people, it might be different. So we are looking at companies that has we're looking at companies that have, there's some innovation, meaning we do not want to be in a commoditized, we don't want to invest in a commoditized company, because a new competitor might come and they might be the existing company might be flushed out. That shouldn't be the case. Return on equity, how well they're managing capital, it's a reflection of that. It should be above 15%. Operating margins, because look, now in fact cycles are every 3 years. Before it used to be, okay, Great Depression comes in the US 1930s, and then markets don't do nothing for the next 20-25 years. But now that's not the case. Now the case is once in 3 years it's happening, and the markets just do not perform for 2 months, and the next 2 months is doing 200%. That's what we've seen. COVID, as soon as we fell by, let's say, 35%, we were up by 60% within the matter of 9 months. So these events like COVID or the next pandemic, the next war or whatever, it is happening very frequently. So when this happens, we should find companies that do not get much impacted. So they have their own, maybe their own supply chains. They've done backward integration very well. They have strong relation with customers. And hence, as a matter of fact, we look at margins as a metric, and we see that we expect it to be above 15% operating margins. The debt to equity should be below 100%. People look at Indian market and say it has grown, but people don't talk about the company that has gone bust. Infra, as a matter of fact, I think 1 in 3 companies have either delisted or completely disappeared from the markets. Even developers, a lot of real estate buyers have poor experiences of them losing money, but not many people talk about it. They only talk about this something called survivorship bias. They only talk about the successes and how well the market is done. So, and one of the biggest reasons is that their debt is so high. They have loaned money, they have taken money from the banks, and the debt is so high, eventually they have to shut shop. So we look at companies that has a low debt to equity ratio, low debt. Then another is, Raghav, something that is underrated in this market is that if the promoter is not right, what can go wrong will go wrong. We have identified plenty of companies. I think 3 in 10 companies that we analyze, something is wrong, like corporate governance issue is there. That promoter is trying to completely take money from investor in a indirect method. It's a very direct thing to say, but when we look for companies, we want to see, okay, promoters good integrity, they have done well in the past. How well are they managing their finances? How much is their remuneration compared to, like, let's say, the revenue the company is getting or profits the company is making? Does the listed company that we're investing into are they doing transaction with another company that is not listed but is 100% owned by the promoter? So if that transaction is happening and it is happening at, let's say, something worth 100 rupees, they're selling it to the related party, meaning the promoter's own company, for 50 rupees. Who's the loser? The losers are the investors, and the gainer is the promoter, basically the promoter. So these are very important areas to look into that retail investors might not get hang of. And again, now completely sealing this, we're looking at companies that can grow about 25%. Then only we can generate good returns. When we invest in 20 stocks, 3 or 4 might not do well. It's only 6 or 7 stocks that does exceptionally well, and the other balance, let's say 10 stocks might just be flat, and that's absolutely fine. That is investing. And when we invest in a company, when we're investing, we foresee a 200-300% kind of returns, maybe in the next 5 years, 6 years. That's the return that we look at. And again, not every company does as we expect. Next slide, please.
So essentially, Shriram, when you put in all of these filters, like return on equity should be greater than 15%, operating margin should be greater than 15%, your growth should be greater than 25%. Say you had 100 companies. Post putting all of these filters, you have had, say, 30 companies, right? That these 30 is your universe to invest in. So when an end consumer or a client gives you 50 lakh rupees, how is this 50 lakh spread across all of these companies? Do you maintain a model portfolio, or do you personalize this portfolio for individual clients? How does that happen?
Raghav, after all the screening, we reject 90%, 95% of the companies. In 6,000 stocks in the market, our portfolio only has 17 stocks.
Sure.
So if someone is investing, let's say 50 lakh, it's invested only in these 17 stocks. And when we invest, it's not that, look, we invest all the 50 lakhs in the 17 stocks immediately. We might invest in 4 stocks first, as phase 1 in the first month. Then second month, we might invest in another 4. So it depends on the market. There is no set rule that, okay, as soon as you invest, we put it into the market. That does not work. We have a approach which is depending on the market, depending on what the fund manager thinks, we invest. Because look, market. Yes. So That's how we invest. So it's just 17 to 20 stocks maximum invested.
Sure.
So this is a quick slide I put up. Look, everyone is ready to talk about their philosophy, and it's very rare that people give examples. So I thought I'll take out one example that we're currently investing in. The company's name is HFCL. There, I had mentioned the 5G growth that we will see, and 5G growth. There are telecom products. Telecom products. Let's say you see a 5G tower. The products that go onto it. So, and in this industry, just to repeat, it's mostly Huawei, Nokia, Ericsson that is providing the equipment that goes into these towers.
Sure.
But there are companies like HFCL, Frog, Cellsat. These are very small companies that not many people would have heard of. These are very unique companies.
Sure.
And these people are making equipments. These are under testing, or many of them got orders as well for equipments that used to be earlier sourced from Huawei. There is some equipment called unlicensed band radio. There is an equipment called FWACP. These are technical terms, but this is the company that manufactured, tested, got approvals, and then got orders for these equipments. And the market size is huge. For example, FWACP, it's a $65 billion market. So when these players are getting eliminated, the international players are getting eliminated, it is companies like this that will see a good demand for these products, for these 5G telecom equipment products that we know of.
Sure.
And the optic and yeah, the second business that they have, first is telecom products, second business, optical fiber cables. It's a very stable business. There are plenty of companies that is into optical fiber cable, but we're giving zero value to this. Despite this being a large contributor of revenue, to this business, we're giving zero value. Despite, BharatNet. BharatNet is an initiative by the government to connect every gram panchayat to a broadband. So every gram panchayat should have a broadband network. Okay, so that better internet services they get.
Sure.
And that's a 1.4 lakh crore opportunity that they have. Then this company is going to defense as well. It's not, these days anyone puts a title defense or I'm going to railways, their stock price shoot up, and everyone is crazy about those stocks. But this company has developed ground surveillance radar software, defined radios, electronic fuse, night vision. These are small equipment that is used by the army, the navy, etc. So these people, yeah.
If you are evaluating any potential companies in defense manufacturing, particularly to drones, specific to drones.
So this company is not into drones. So defense, what's happening is the multiples are very high. It's like if a company is doing 100 crore revenue, it's trading at 800 crore market cap. Like 8x is the current like multiple, even for a drone company, let's say.
Sure.
And so there are many companies going into drone, but getting the approval is the most important part. So these companies are into equipment of which goes into defense, and they've got small orders, and many of the products are in testing negotiation stage. So we see a huge value unlocking coming from this company because of firstly telecom products, and secondly the defense part of it. And optical fiber, to be very frank, we are not giving a value because there are many players that is doing it.
Sure.
So this is our kind of and research process, yes. And as a company, look, we are managing AUM of 600 crores and advising around 250 crores. And through our advisory and PMS, we've served over 30,000 plus investors.
Sure.
So these companies run by two chartered accountants. One is Devam Sharma. He's a graduate from Indian School of Business. He's worked in Citibank and Kotak Mahindra Bank prior to starting Green Portfolio. So and second is Anuj Jain. He takes care of the research side. He's the research head, and he used to be a practicing CA before starting Green Portfolio. So these two co-founders, they met during the articleship days back in 2014 types, and they started the company. And initially, it's always you start with friends and family money. Then when you gain the confidence, you start taking outside money, and slowly they grew. So in 2014, they started the company, and 2018, until 2018, they were managing friends and family money. 2018, they got the first investor, and we have grown. I mean, performance has done well. We don't do much marketing, but performance is helped us. Yes.
So I think we are running out of time. If you could quickly just cover your strategies and then we'll move into FAQs.
So main is special fund. Yeah. So this is basically showing how well it has grown in the last 5 years. We started in 2018, and this is how it is done. It is done four times. So 1 crore invested would have been 4.11 crores. We've grown at a 28% growth year on year, and this is after fees and after brokerage charges. If you look at any other PMS, also they show after brokerage charges and PMS fees, but
Sure.
before taxes deducted. Yeah. Oh yes, this is the how we do it for NRIs. So what specialists for NRIs, we have good experience. We have NRIs from 25 countries. So how we do it is, firstly, once you've decided to go ahead with the PMS, you share your basic KYCs like PAN card, passport copy, nominee details, like your address proof, and then we prepare a pre-filled kit. So basically, for NRIs compared to local investors, it's different. You need your own demat account, bank account, brokerage account. So three things are very unique to you. It's not pooled. So what happens in local case is that bank account is pooled and broker is pooled. Only demat is exclusive. But in this case, all three are exclusive for NRI clients. It's not just with us, but it is by mandate. It has to be exclusive. And
Correct.
then once you sign the documents, etc., once you've sent you the documents and you've signed the documents, we'll get DHL to pick it up from your address. And then account is ready to fund within 2 weeks. After it is ready to fund, once you invested, then we send you monthly reports, how your portfolio is doing. We can have a call with the fund manager on a one-on-one. We are not into that, you call all the 250 investors and do a presentation, meaning we're not into that, because every investor that is invested with us, they'll have their own unique portfolio. So,
Sure.
and taxation, yeah, go ahead.
So I think these are the top queries. So I'll take them one by one and you can answer them, right? So is PMS SEBI regulated? Yes, it is SEBI regulated. I think the other one is interesting. What is the disclosure mechanism of PMS? Particularly, I think it means towards SEBI. So how do you disclose all of your performances, documents, and also towards clients? How can they see their performance?
So if you see, if you go to the SEBI website, every PMS is listed, is there. All SEBI registered PMSs, you can see the AUM, how much they've grown, etc. Everything is there. So we report on a monthly basis. That is by mandate. There is no shortcuts to that. So we report on a monthly basis, and then we report to the client also on a monthly basis. Like client portfolio, meaning the entire fund is, let's say, 800 crores. Client portfolio is 1 crore, 2 crore. So that report is also exclusive to the client.
Sure. Then we have what are the documents required to open a PMS? I think basic KYC documents
Basic
are required.
KYC documents, but for us, we want a nominee, because as an invest, meaning God forbid, you don't know what might happen in the future. So we require a nominee for sure.
Sure.
So nominee document is also required, just passport copy or PAN card.
Sure.
Extra.
So typically your PAN card, your overseas address proof, your Indian address proof, your nominees and your bank details typically should suffice. These are the broader set of documents which anybody requires to invest in a PMS.
Absolutely.
Right. What is the onboarding process? I think that we have already covered. What are the charges and fees for the PMSs, particularly for green?
Particularly for green, we are mostly into performance based. So we charge a small 1.25% fixed fee. And then on the performance side, we charge 15% once your returns exceed about 10% in any year. So if your returns are not about 10% in any year, we only charge you 1.25%. If it is if it is below, we only charge you 1.25. If it is above, we charge 1.25 plus the 15% on the excess returns. It's
So
a
essentially,
hybrid structure.
say essentially somebody gets 20% return. So 20 minus 10 is 10, 15% of 10 is 1.5 plus the fixed 1.25. So essentially in that year, you would take away 2.75% as fees on a 20% return.
Correct. Absolutely.
Okay. How are NRIs taxed in PMS? So same taxation, equity market, short term 15%, long term 10%. What are the risks and returns of investing in a PMS? I think we had this question in the chat as well. Particularly, this also compares it with mutual fund. So let's say, what is the risk ratio of a PMS versus that of a mutual fund investment?
So every PMS is different. So what we've compared ours to, let's say, the top 5 small cap funds, and our risk was lower and our returns were slightly greater than, so around 3% CAGR compounded basis, ours was greater, the returns. So it depends PMS to PMS, quite frankly.
So for green particularly, your risk was lower as compared to that of small cap mutual funds.
Yes.
Got it. Okay.
So, for
Is it?
example, to put it,
Yeah.
during COVID is one of the biggest drawdown we've seen. Our fund fell by 25% when the benchmark was down by 35%. I'm just talking about Nifty 50. Uh, so that is a clear indication of how volatile the portfolio is.
Got it. Is it possible to withdraw some money from a PMS account? I think
Anytime, look, I want to make clear that we don't charge any exit fees, because you decide to invest and it might come a time that you want the money back. It's because you need the money. It's not, you're doing it because of any other reason. So there is no exit load we charge. It's zero. You can take it out anytime. Let's say that 50 lakh has become 70 lakhs and you want to withdraw, let's say 20 lakh profit. Absolutely fine. Now, let's say you decide to invest for 3 years, 5 years, but then circumstances say that you want to prematurely withdraw, like all the 50 lakhs, all the capital, that is also fine. But we do not want investors that have a horizon of less than 3 years to invest, because they won't be happy. We won't be happy, because returns usually take like more than a year, more than 1.5 year to actually show a good, healthy rate of return. So,
so. Do you have any app where the investments could be tracked, or let's say a web dashboard wherein clients can see their individual portfolios?
yes.
Got it.
This is it's a web app. They can use it through phone as well. It is updated daily. So by 9 p.m. India time, it gets updated live.
Sure. What is the lock-in period for PMS? Like you mentioned, no lock-in. Can NRIs invest in PMS through NRE, NRO accounts? Yes, both of these are possible. Is PMS better than NMF? Very, very interesting question. So I think I would want to add. So let's compare green portfolio with one of the best performing small cap funds. So how do you feel PMSS beats the MF performance? I think your benchmark should be the best performing mutual fund in that category. For your particular example, a small cap fund. So
Yeah.
please take this.
If I look at a long, I'll give you two directions. I do not want to sugarcoat it.
Right.
So if I look at the last 5.5 years since we started, we have beaten the average of top five mutual funds, small cap mutual funds. I'm not even going at mid cap or large cap. But let's say if I take last 1 year, you want short term also 1 year. I mean, there is hardly any short term investors, but I do not only want to say positive things. If you say 1 year, if there are around 24 small cap mutual funds, ranking wise, we were fourth. So, but we're looking at long term returns. Long term, we've beaten. Short term, because of whatever reasons, maybe luck or whatever, we ranked fourth in the entire 24.
Got it. Okay. As an investor, what is the expected time horizon that they need to bear in mind when investing in a PMS? So I think you mentioned long term,
Yes. It
right?
has to be minimum 3 years.
Got it.
Because look, if a company, we're investing in companies at the end of the day. And if companies' revenues are growing, profits are growing, stock price will also grow, as long as there is no major issues in the company. So for that business growth to happen and that stock price to reflect that business growth, it's not okay, one day business grows and the next day the stock also grows. It takes time. There is a slight lag. There is a 6 month, 9 month lag to for stocks to reflect the growth in the company.
Sure. So the next question is, where and how will my money be invested in PMS scheme? I think where we know, stock markets, general stocks is where your money is invested. How will my money be invested? Obviously, Sriram essentially mentioned how they construct a portfolio. That is how your money gets invested. Also mentioned that your money is not deployed entirely at day one. They take technically about 4 to 6 months to typically deploy the entire capital. Am I correct, Sriram?
Absolutely. For that, as an extension, currently we're sitting on 25% cash for new investors. So we are not going to invest all that money in one shot. And at the same time, an investor cannot be like markets are high, so I will not invest, because markets has been hitting new highs since the last 9 months. So if you were sitting out, uh, it's basically you an investor would have lost out. So it is important that you see those specific opportunity. So it's not like we're investing in the entire market, we're investing in stocks. We're not investing in markets, we're investing in stocks. So as we find opportunities, we will invest.
Got it. Second, how do I reach out in case of any queries if I were to invest? You can reach SBNRI via your application, or if you have an relationship manager assigned to you, you can quickly get in touch with us and we can help you in investing in the PMS, right? Anything you want to add, Shriram, before we end?
I think to my previous point, so when I speak to people, it's usually their concerns are INR depreciation, then the documentation, and then you have, should I invest? Is it the right time? So first, I'll quickly wrap this up. So firstly, the INR depreciation in INR will do better than how it has done previously. India was not in a strong position during from 2002 all the way to 2015 as it is now today. Secondly, uh, the documentation, etc. It's easy with us because we have that experience. There are pages and signatures that is needed, but we make from A to Z, we take care of it. We bear the trouble of sending you the documents, getting the documents from you, submitting to the custodian, and then following up and activating account within 2.5 weeks max.
Sure.
Uh, I think that's it. And is it the right time? Sorry, if it's the right time. I think if you are investing in the entire market, it's slightly elevated. But if you're looking at individual stocks, there are still stocks in our portfolio that is trading at a 10 p, 15 p, which we foresee a good growth. So it's stock specific, and rather than investing in the entire market, be stock specific. Yeah.
So we have one question in the chat. Have you considered monthly dividend paying portfolio schemes in the future?
So why, when do a company pay dividends? Okay, to answer the question, yes, we have a dividend yield portfolio as well, and so which is a PMS strategy, and there is a very small amount we manage. We manage 8 to 10 crores. So we have considered that. Now, why do a company pay dividend? Because their cash flow is stable, their profit is regular, but when we invest in a company, we are mostly looking at capital gains rather than the dividend side of it. Yeah. So we have considered, to answer your question, yes.
Sure. Also, yes, they do have a dividend paying scheme. So let's say if you're looking in investing a PMS just to earn dividends, yes, that is also there. If I'm correct, yes.
Yes, absolutely. But another thing to be noted is that when you look at the total returns, 1% dividend growth is shown as 1% capital gain. There's no differentiation when you look at the returns. But as a person, when you actually look at the money you've reserved, 30% is gone for taxes. But because tax on dividends is 30%, tax on capital gains is only 10%.
Correct.
That is a perspective. That's all.
Sure. So I think it was good to have you, Shriram. Good to have all of you. Thank you so much for joining. If you like the webinar, and so we keep conducting webinars on different products, different asset classes, particularly for real estate, taxation. All of this information is available on the SBNRI app. So you can quickly download the app and follow us through. In case you have any questions with regards to PMSs, particularly for green or any other services which SBNRI offers, you can download our SBNRI app. The link or everything, our offerings are available on the screen. You can connect with your RMs. Thank you so much for your time, Shriram, and thank you so much uh, for connecting on the weekend. Thank you.
Thanks for having me, Raghav. Thanks very much. Thank you. Thanks.